topic in last webinar was AIA, and it was, the share price was $61.25 when we had the last webinar in early May, and it's now about 3% lower. We kept the buy waiting with a long-term target price from fundamentals and valuations of $95. AIA reached 66 and 15 cents in mid-May after our last call and followed the overall market to pull back, and we didn't see any particular negative catalyst on AIA's fundamentals. The recent consolidation is mainly driven by the market performance, we believe. Okay, let's go to our latest market update. In May, Hong Kong stock rose more than 300 points, mainly lifted by index heavyweight financials, and Chinese equity saw continuous interest from investors following policy measures from the Chinese authorities to support property sector to ease concerns on economic outlook, and we still expect a gradual uptrend for Chinese equity, although the H side down from 19,700 level from mid-May. It is a typical technical pullback, we think. And about the latest economic data in recovery, the April week credit demand shows that the M1 money supply for 1.4% year-on-year, but M2 money supply growth dropped to 7.2% year-on-year, as new bank loans came in below expectation, and in addition, the new total social financing saw a rare contraction, the first denied in 2013. This contributed to slow outstanding total social financing growth. This point to weak demand for credit, and China needs a combination of monetary easing and fiscal expansion to support sustain the recovery, we think. And looking into the data, the M2 growth dropped 1.1 percentage point to 7.2% year-on-year growth in April, and missing market consensus of 8.3% year-on-year growth. And the M1 money supply growth was also slower than expected at negative 1.4% year-on-year, which signals weaker transactional demand for money, and banks acted only 0.73 trillion renminbi new loans during April, and new household loan contracted in April also, and among which medium and long-term loan fall in a reflection of weakness in the property market, and new mid- and long-term loans to corporates was down also, underlying poor investment demand. And other than the credit data, we see the CPI growth 0.3% year-on-year in April, and above market expectation of only 0.2% year-on-year growth, and marking the third consecutive month of increase. And the PPI inflation came in at negative 2.5% year-on-year, which up 0.3 percentage point, and extending the 1.5-year stretch of delights. However, global commodity price inflation will soon return to positive, and is likely to support a further narrowing of China's PPI. And a key question is whether manufacturers will be able to pass through the cost increase. And we think that this remains unclear whether the higher global commodity price can help ease deflationary concerns in China going forward. And this mainly rests on the manufacturer's ability to pass on the cost increase, and is something to be monitored. and wouldn't positively finish the latest property sector policy, and on 11 on 17 May, the central government issued a policy package to stabilize the property industry. On the demand side, first, the minimum down payment ratio for first and second homes purchase was reduced from 20% and 30% to only 15% and 25% respectively. And second, the floor of first and second home mortgage interest rate will be removed. And now third, the PBOC will provide 300 billion RMB in low cost to set up part of supplemental lending PSL to banks. And this will be used to support local SOEs in acquiring completed unsold units from developers and converting them into rental or for sale government housing. And on the supply side, the government will first further accelerate the implementation of the whitelist loan, and second, use developers to speed up the start of undeveloped land, and third, support local governments to buy back raw land in the hands of developers that experience financial difficulties and build more government housing. And the eliminations of mortgage rate fall is a positive surprise, I think, as the global economy nears the end of the cycle of interest rate hikes. The action to remove the mortgage rate fall is positively shift home buyers' expectations. And after all, potential LPR cuts are expected to be a significant driver for the real estate market in the future. And we expected a limited impact from further reduction of minimum down payment ratio. And the 300 billion RMB PSL funding is to support destocking is below market expectation in scale, but it has improved the mechanism. And besides smaller funding size, the central government also opted to ask local SOEs to buy completed inventories from developers rather than second-hand units from residents, thus preventing a significant rise in residential debt level as seen during the 2015-2016 inventory reduction cycle. And notably, the PSL has become more flexible. First, loan tenure is set at 1 year with the possibilities of 4 extensions. And second, the PBOC will no longer regulate the lending rate that banks charge the acquired rates, which should be no lower than 3%. We expect accelerated renting of the 300 billion PSL. And also for the removal of mortgage rate floor, it is stronger than expectations and is balanced with a smaller PSL scale for the stocking. This reflects an overall prudent attitude of China's central government towards the property industry, with sufficient implementation by local SOEs and banks. We expect property prices to stabilize in 2025 next year, but with possible higher price volatility in 2024 this year. The policy combo announced on 17 May gives us hope for market stabilization. And after policy, let's go for the valuation of Hong Kong stock. The Hang Seng Index is trading at around 8.7 times 12-month forward PE, remain undemanding compared with history. Is more than one standard deviation below the 10-year mean. We expect policy support to continue, and next month is important meetings. Chinese meeting will likely see the roll out for further supportive measures. And in terms of technical analysis, the Hang Seng Index has tested the high at around 19,700 since August 2023. It then pulled back for more than 1,600 points. However, we believe it is experiencing a healthy consolidation. Hong Kong stock has up sharply since mid-April, and with cumulative gains of more than 3,600 points. Some technical indicators, such as the RSI, has been overbought for an extended period, shows a correction in the market is healthy, and the first support for the Hang Seng Index is 18,300, which the HSI is testing this level in recent days, and the next support is 17,800. And we believe HSI can maintain the uptrend as long as it does not lose this level, 17,800. And for the stock selection strategy, we are continuously positive on beneficiaries of improving domestic consumption and among the sector within. Company with overseas expansion or turnaround prospects, and companies that have upside potential of improving operating efficiencies. Companies that will benefit from near-term catalysts, for example, some event-driven factor, and company have increasing dividend payout will outperform. For example, beer companies expect premiumization to drive revenue growth, despite overall volume growth being slowing down, and raw material price easing. And premiumization should be the key factors to drive margin expansion for this year 2024. And beer companies to domestic the exposure to domestic growth, the sales momentum, thanks to the upcoming summer season overlapping an easy base from April as well. And come to our stock today, the company, China Resources Beer is a listed subsidiary of China Resources Holdings Company, and the group focuses on the manufacturing, sales, and distribution of alcoholic beverages. As at 31 December 2023, the company has 63 breweries in operations in China, and CLB owns several brands in China, including Soul, Sihu, Kingwei, and and there are some overseas brands China business. By volume, Slow is the world's best-selling single beer brand. And for its latest result in 2023, CLB's revenue was renminbi 38.9 billion, an increase of 10.4% year-on-year. The group's net profit in 2023 increased by 18.6% and compared to last year. And in which respect of the beer business, the group's overall beer sales volume in 2023 has increased 0.5% compared to last year, and the sales volume of sub-premium beer segment above was increased by 18.9% year-on-year, and among the brands the sales volume of some premium brands in total record double-digit growth as compared to last year. And in respect of the Baijiu business, the group has completed the acquisition of more than 55% equity interest in the new subsidiaries in total fee and turnover and earnings before interest and taxation of the group's Baijiu business in total fee was renminbi in total fee recorded significant contributions from the Baijiu, and the board recommends a final dividends of renminbi 0.349 per share for the year ended December last year, and a special dividends of renminbi 0.3 per share for celebrating the 30th anniversary of the group, and together with the interim dividends per share for the 6 months ended 30 June, the total dividends for the year 2023 will amount to renminbi 0.936 per shares. And looking forward, let's go through the catalysts. We expect double-digit percentage premium beer volume growth in 2024, and we can see that CLB's 2023 result is in line with our expectation. Particularly, gross margin was 41.4%, and increased 2.9 percentage points year-on-year, with margin expansion benefiting from the exaggerated premiumizations and decline in packaging material costs. The net profits was 19% higher compared to 2022, beating market consensus by 1% and in line with our expectations. And net margin was 13.2%, up 0.9 percentage point year-on-year. The beer sales volume increased 0.5%, as we mentioned, and the total beer sales volumes is almost 11.2 million kilotons in 2023, and higher than the industry growth rate of 0.3% only. And the average sales price rose 4% year-on-year, while per unit cost increased only 1% year-on-year. And we think that the solid results has supported share price rationing, and for the premiumizations, we think that in 2 to 3, the volume of sub-premium and above product was in 2.5 million kg in 2 to 3, increasing by 19% year-on-year and contributing 22% of total beer sales volume. And among the brands, sales volume of overseas brand growth by nearly 60% year-on-year, achieving the first 5 operational target of and most sales volume of 12 bags and other local premium brands record double-digit year-on-year growth. And looking into 2 to 4, although management expect beer sales volume to record a slight positive year-on-year growth, sales volume of the premium and above beer segment is expected to achieve double-digit percentage year-on-year growth, with the overseas brand expect growth at 25 to 35%, and the Snow 12 bands to growth 25%. And we also like CLB beers for the competitive product mix. CLB start partnership with overseas brands since 2018 and owns the brand in mainland China, Hong Kong and Macau, and the brand has leading the premiumization of CLB. And looking ahead, management still sees great growth potential in the premium beer segment, especially in off-trade channels. Although growth pressures may persist in catering channels, and management expect the brand to continue to lead the company's premiumization and consolidate its leading position in the premium beer segment during the second 5-year plan, and the brand's sale volume is expected to reach 1.2 million tons, which will be supported by further penetration in non-core markets, such as Anhui, Sichuan. And next, we think the Baijiu business is going to back to normal, and the inventory level has already returned to normal with current inventory volume down by RMB 800 million compared with that of last year, an equivalent to 40% of annual sales, and this results in stabilization of the Baijiu brand's ASP. And the brand core product shows strong sales momentum, recording sales growth of more than 50% year-on-year in the first 2 months of 2024, with bottom opening weight also improving to 24% versus only 14% previously, and looking ahead with its core products normalized inventory and strong sales momentum as well as more diversified product mix, management expect the Baijiu segment to achieve revenue of RMB 8 to 10 billion in midterm. And also the catalyst we see 2 major risks for CLBs in the future. First, more intensive competition in the premium beer segment, and second, higher than expected marketing expenses. And here, let's have a look on the key financials of CLBs. And for the management, we maintain our positive view of CLB premiumizations, backed by its competitive product mix and strong channel management. And CLB is our top pick in the beer sector. We maintain made the average capital growth of 13%. And terminal growth rate of 2% in our DCF valuation model unchanged. We set to reduce our target price after the results now is 65.5, and the stock currently trades at 18.8 times 2 to 4 PE, which is undemanding.